Okay,
Okay.
this should be recording.
Awesome. Well, welcome everybody. Let's kick this off. Thank you for being on. Thank you for being on our quarter one market report. Here we are, last day of April. We are ready to cruise into the summer, the hot months of seasonality with our real estate market. And it's interesting, Rusty, we'll see. A lot of times I do this so often that I kind of come up with a little bit of my biases, and I have to remind myself every time I review this stuff to forget how I feel and just truly authentically look at the data
Yeah.
because a lot of things that I thought might happen have not happened. And other things I thought were not going to happen are happening, but I don't know if you know this, but we actually started launching missiles at a country called Iran a while ago, and it has definitely messed up all sorts of economic data for us. I
Yeah.
think it's just created such instability that, every other day I wake up to a news article that like, oh, we solved this. The next day we're like, oh, we are not solving this. Next day, even like the United Arab Emirates leaving the OPEC. Like there's just always so many crazy announcements that definitely have a dramatic effect on the economy, but sometimes we have to still look at the United States. But then sometimes it's nice to kind of run back to our Utah bubble of just, awesome economics for the most part. But we'll go back and forth between those two data points. So, if this is your first time on, welcome. We do this every quarter. My name is Johnny Christensen. I'm the regional director for Keller Williams Utah. We have our awesome co-host, Russie Edwards. She is our team leader, CEO of the Keller Williams office up there in northern Utah. Covers the Davis, the Weber counties. You got a big territory up there, but you've been a leader in WCR, the Realtor Association. You just have been a super salesperson. But Russie, welcome to our
Hey,
call today.
I'm excited to be here. Thanks for asking me to co-host.
Absolutely. You're the brains and beauty. I'll just help run and click the slides. All
We
right.
already established Gordon was the brains,
Oh,
you were the beauty. I'm just here in the background, like, hello.
yeah. Well, yes, we always have to fill Gordon's bucket. He makes this tremendously easy. He is
Yes.
always pulling all this data together. Gordon, you need to start tallying up how many hours it takes you to prepare all this and update all the data, but it is definitely a lot every quarter. And we have, I don't know, still 70, 80 different sources, and some update immediately, some take until this morning to update just so Gordon get these slides accurate. And as always, he packages these up. KWUtah.com is where you can download the PDFs. I love seeing these in our buyer and seller presentations. I love seeing them in PowerPoints and all that of our agents. So I'm glad you're using them. That is why we do it. And then also for the video format, if you want to see Gordon and Russie's pretty faces, definitely tune in KWUtah.tv. We'll be ready tomorrow, just this recording. But let's jump in. Let's have a discussion, Russie, as my co-host here. Let's have a discussion just on all things market. So, like always, we jump from the United States perspective of the real estate and economy, and then we kind of dial in on Utah, and then it's kind of up to you to dial into your cities and counties just with the data we give. But realtor population, this is one that NAR isn't great at releasing these. I don't think they like putting out their numbers. But it looks like UARs, took a turn upwards. We've added some realtors in the state. And if we had the live data, I would guess we might have been down a little bit, would be my feelings. Russie, you're tapped into the association.
Yeah. Yeah, I agree with that. I think we're probably down a little bit. You can see this. It looks like we're making a little bit of a rebound. But the interesting thing to me is I think it is interesting that NAR doesn't release their numbers. Ours, we tend to see people drop off when those renewals happen at the board level. But I think there's a lot of people that thought that membership would drop more drastically than it has. So I feel pretty confident about just our continued growth.
Totally agree. And we love our realtor population, but if they're not
Yeah.
doing anything, they might as well be out so we can get these sides per agent up a little bit. But here's the
Yeah.
latest data. UAR is the orange line. NAR sides per agent, a little bit higher than the state of Utah. UAR average 6.07. So let's trend towards that direction the next 12 months. But we've talked about this, that lock-in effect of all those low rates still, the average tenure of homeowners staying in their homes, 9.3 years. The days of 6-year turnover is definitely gone, definitely
Yeah.
all over the state, 9.3 years. But here's, let's kind of just give a lay of the land and outlook on what we'll be talking about today. Here is the basic snapshot of the Utah real estate market. You can see new listings. If you just look year over year from the first quarter of 25 and you compare it to how did we start this quarter, a lot of positive numbers. So it feels like, we're kind of getting a little bit more units out there. Things are moving in the right direction, but 2.9% more listings came on the last 3 months than from the year before. Pending sales is slightly up. Like to see these closed sales going up, which is great. We're up 3.4% on closed sales. This is all statewide, so all of Utah real estate. Days on market's up a little bit with a little bit more inventory, though. Even though closings are up, we still see days on market going up. And the first 3 months of this year, starting out compared to last year, we're up 2% appreciation. But we're going to kind of dive into that because some of the unpredictability, we'll see where that ends up on appreciation. But so far, we're starting out the year strong with the 2% above where we were last year. And then percent of original list price, pretty much flatlined, just what it's listed for, what it ends up selling for, 96.2%. Housing affordability is flatline right there. We saw rates going down a little bit. They came up a little bit. Prices a little stabilized, but still right at 80 on that index, and a little bit more inventory out there. So if you're showing buyers, hopefully there's a little bit more homes that they can use as their options. But that's up 5.8%, and then just trickled up just barely 3.8 months supply of inventory. If no more homes came on the market, it would take 3.8 months to sell out the existing inventory on the market. So there's our snapshot, and then we'll dive into all of these. And starting out, I wanted to highlight, I know we always have guests, which we always welcome them, and our vendors, but our Keller Williams agents on this call, I wanted to highlight how much you are kicking butt starting out the first quarter this year compared to last year. So if you look on the right, new listings in the state are up 2.9%, 1.7 on pending sales, 3.4 on closed sales. This is KW Utah Family. So this is our numbers, Keller Williams agents. New listings, they're up 29%. We are crushing taking listings. Pending sales 15%, and then closed sales up 16.3. So if you look at those left categories, our Keller Williams Family is outpacing the Utah real estate market by 26% on taking more listings, and even closed sales. We're outpacing the market 12.9. So that's how I look at it, is what is the market doing, and then what are our people doing? And it's just a great start. So any comments on that, Russi?
Just an awesome start to Q1. I think January started out looking a little shaky, as we're going to see in the numbers. And man, we've just really rebounded. So this has been exciting to see our people just taking more listings, more pending sales, closing more units in a market that, frankly, there's a lot of people that are making excuses about not being able to sell as much real estate. It's fun to see us selling them more and outpacing the market.
Yes, yes. So shout out in the chat, any of you that are having your best start to a year, and also Russ, if you don't mind monitoring the chat in case any questions.
Yeah, of course.
There. So let's talk about home sales. If you look at the country, these are annualized numbers. So the country started out a little less. So they're kind of 4 million homes sold. We have hit 4.1, 4.1, 4.1, 3 years in a row. And then even percent, that green line, percent of households that sell, and that was 3% last year. So again, I think a lot of the unpredictability of the market and oil and all those things just kind of didn't give us that oomph of a start. A lot of us projected more sales, better rates, a lot just of us moving in the right direction in the real estate industry. I think the unpredictability kind of just made, for the most part, the United States, it feels like we're starting out like we did last year, which I think we were hoping it was a little bit faster, but I know Utah's a little bit faster start, but the US, not so much. If you look at just kind of on a monthly basis, each one of the 3 months, I kind of underpaced where last year started out just by a little bit. If you look at kind of just our stats here, Gordon puts the actual sales, not seasonally adjusted, but just actual sales every single month. You can see 2025, 40, 62, the year before, almost dialed in exactly on that. So we'll see how this goes. But here is just annual new homes sold. If you take all those new construction, the fresh new smell of a brand new home, like a new car, but 587, this is annualized as well. So just those new homes coming on the market in the United States is a little less than last year as well. So I think coming out of COVID, I don't know about you, Rusty, but it feels like we had a ton of inventory kind of coming on. But then somewhere around 22, 23, some of those builders just started buying a little less projects or maybe selling off a few of their projects. So we'll see.
I definitely think we've seen that. And we see that again more in some of the other slides, but you're definitely seeing builders kind of just being a little more cautious again.
Yep. You can see just kind of monthly start there in January, a little lower, but here is annual homes by year here in the state of Utah. So again, outpacing the start from last year by 3.4%. So a little bit more closings, which is nice to see. That's benefited all of our Keller Williams agents. But again, the springtime, summertime, there traditionally is just more sales that come on. So either I just think it's going to be a really hot spring and summer, most likely. I think, some of just the oil and all the turmoil could just kind of like hold us back a little bit. But for the most part, just at least a good start. And you kind of see, February was a little flatline, but I just felt like March kind of popped. And I don't know
Yeah.
about you, we haven't closed our books for April yet, but it feels like April was a pretty great month statewide as well. So I think we will outpace probably in April, would be my guess.
Yeah, I agree with that. I think April's going to be a really strong month when we see these final numbers.
So let's talk about prices. So again, there's two ways of looking at prices. So how did we start out the year, the first quarter compared to last quarter? So if you look at the United States from first quarter to second quarter, I mean first quarter 26, they're basically flatlined, up 0.4%. But if you actually look at the average price all of last year compared to where we started this year, we're actually under. So again, a lot of times it's the summer, you start seeing those prices going up, and then on average, you end up a little bit higher than the year before, just like 25 over 24. But right now, we're starting the year out below the average price last year. So the median price right there, year to date, is 401. We ended the year with a median price throughout the whole year at 414. So we are right on that trend line right now if we don't get prices kind of booming up a little bit. So you can kind of see that seasonality right here. You see kind of where we started January 25, 397. We popped right there around June at 435, and then it kind of went back down again. So that's why you average out at that 414. But then you see January, February, March, we were just sub 400 and then 409. So again, we're still better start than we were in 25, but overall, our prices are still lower than the average last year, which right here can play into that payment. So we've had a little bit of improvement on that affordability. A lot of those categories we track. So the median home payment, principal and interest, 20% down on a median purchase price home right now in the country at the end of March was 1999, just right under 2000. Little marketing tactic there, right? Here's a lot of those shifts, appreciation, ups, downs. You can see Fed lowering rates. You start seeing that, appreciation. But, for the most part, we've kind of just been a really steady 1, 2, 3% the last couple of years, which is probably what we needed after COVID, right?
For sure. Needed a little stabilization there.
Yeah. And same story with Utah. Again, a better start. So we're up 2% compared to where we started last year's first quarter. But if you look at the average price all last year compared to where we're starting out this year, we're just slightly, almost even, but right at 510. Can you believe our median price in the state of Utah is 510? Just looking back to when I started, we were in the hundreds for sure. So definitely that purchase price has been going up. Same thing, seasonality. I know sometimes Park City, they can have a great winter, but a lot of times your prices peak in the summer, sometimes in the fall here in the state of Utah. We started last year at 505. We got upwards of 525 there in October, but then kind of where we started out, 505, 505, 519, but just with that interest rate overlaid. So again, for the most part, that last half of last year, those rates were coming down, which for sure has benefited us on that price and the interest rate just on lowering that median home payment. So right now, the state of Utah, 20% down on a median home principal and interest payment. You're at 2,537.
So we're nearing $600 more per month than the
Mhm.
US average, the US median
Yep, yep.
here in Utah.
And when we get to income, I was surprised. Some of our income has been we definitely lead the nation on income per household. So I think that kind of helped play into
Oh,
affording
yeah.
houses. But here's just the overlay of United States as the purple, and then you look at Utah. Again, we were in lockstep on pricing up until about 2015, and then we just started separating. The boom of the Utah economy kind of got roaring, but we officially are at prices, median home price in Utah. Look at back at 2022. So post-COVID, we saw that a little bit depreciation, but now we're back at that 510 start. And then Gordon has been AIing his nights away, creating us some good little graphics that have a lot of info. These are some great ones to print off and put in your slideshow. But here is just the income to afford a medium priced home in the state of Utah. So again, if you look at statewide year-end price last year, 512,000 across the state. You look at the average year-end mortgage rate of 6.6, the way that we ended. If you were to take 30% of the average household income to go towards principal and interest payment, what type of income does a household need to afford a median purchase priced home in the state of Utah? So right now, if you do that calculation, we're looking at $144,000 of median household income it would take for 30% of that income to go to that mortgage payment. Okay. So we have seen some improvement, which is great in that category. So just a little lower requirement on income, but 144,000. But also Gordon threw in the counties, which is cool. Just kind of see the counties. Again, Summit, our fancy folk in Park City, 273 is where we ended last year, but 262 in March all the way down to our friends in Wayne County, 104,000 still needed, but definitely six digits in all those. Any comments on these, Russie?
I just think this is interesting to watch, and it's good. I feel like the incomes are going up in Utah, so that's good because it does help with people being able to have home ownership. But also, I had to look up where Wayne County was, and I said, "Is that a place anybody wants to live?"
Hey, the only reason I know
Just
Wayne County is because Clay's parents live in Wayne
just
County.
out of
That's
true
how I
story.
know.
That's why I was like, "Where is?" I looked at this and I said, "Where is Wayne County?" And I looked at it on the map and I said, "I think I'll stay where I'm at. I'm okay."
U.S. young adults, Russie, we might have a few of our agents on the call that they have one of those kids,
Yeah.
25 to 34, still moving back in with them. We are officially record highs at 17.9% of that age bracket that are back living with parents or grandparents.
Yeah.
Um, do we have
This is
any?
one that's interesting too. I think we're going to see this. I think this is a trend we're going to continue. I think there's a lot of builders starting to even accommodate for this in ways of just, ADUs and people having their kids living with them longer. It's just I don't see this being a trend that's going to change anytime soon, where our affordability is right now.
Totally, totally. Yeah, just renting prices, buying home prices, like the lack of inventory, like we've seen where that shows up, and that's more, young adults moving back in, home. Or maybe they never leave. I don't know, Russie.
Yeah.
Homeowner rate comparison. So this is the percent of population in the United States is purple, and then Utah's blue. What percent is homeowner rate? So again, we've always Utah been a great homeowner state. We're at 68% homeowner rate. It has gone down though. If you look at kind of the peaks of the 76 percentile, still not terrible. But again, even 2021 was 68%. So we haven't seen this dramatic fall of homeowner rate, but it has gone down a little bit over the last, decade or so. So that's something to monitor. Home ownership is always, such a pride in America, but also just the net worth comparison of a renter versus a homeowner, just dramatically different. U.S. inventory kind of flatlined, 4.3 months of inventory. Again, we consider that balanced market. 6 months. I think 4 to 6 months for me is my favorite market. Russie, what about you?
I completely agree with that. I think that this is really, to me, the 4 to 6 month mark, even like high three, four, to me, that's the market where things are moving. If you're pricing things right, everything's kind of still moving. It's not crazy. It's not wild like when you're dipping down into like 2 months of inventory. But it feels better than to me a 6 month balance. To me, 6 months isn't quite balanced. It's more we're starting to edge on the side of a buyer's market for sure after at 5 to 6 months, in my opinion.
Yeah, I think sub 3 months just moving a little too fast. It
A
kind of
little too
creates a
fast.
little bit of urgency on our our realtor population, a little bit of stress because everything has to be
Yeah.
so quick. You get above that 6 months. To me, that was just a little bit harder because I would get
Yeah.
lists from my buyers saying, "Hey, I want to see these 78 houses that are sitting on the market." So I'm like,
Exactly.
okay, let's have a little less inventory.
Yeah.
Again, we started out the year pacing, above our till, our 2025 lines. So just slight climbs. But if you look at, kind of inventory last year, we really kind of started peaking in that summer months.
Yeah.
So it'll be interesting to see. Are we going to start, eating into that inventory the next 3 months, or are we going to see that trickle up another couple percentage points? U.S. pending home sales, again, pretty much flatlined just on under contracts. Same thing. We're kind of in the United States, it, again, just started out the way it did last year, is kind of
Yeah.
how a lot of these numbers feel. But if you look at U.S. new single family housing units completed, right there, 930,000 homes completed is the projection kind of annualized number. Still looking a little lower than last year on homes completed that are out there selling the new home category. That was March, right? You kind of just saw a drop right there in March of just new inventory. But again, you look at Utah, a little bit different. The annual months of inventory, even though more listings have came on because sales have picked up a little bit more, we've seen that annual months of inventory slightly shrink from 4.2 to 3.8 months of inventory, which some of these categories are interesting. I had to really dial into this data because we've seen days on market trickle up a little bit, even though annual months of inventory has came down a little bit. More listings have came on, but more sales have happened. So it kind of just given a little bit of, up and down on a few of these categories. But even just, it was really January that kind of pushed us above last year, but then flatlined the last couple months. And then even new listings right there. So far, 16,555 new listings have came on the market, 2.93% above where we were last year starting out the year. But if you look at 25, it was a good listing year, 63,000, right on that 15-year average trend line. If we're outpacing that number, we could end up, what, maybe 65, maybe 66,000 homes coming on the market. I think you're finally starting to see some of that unlocking of the inventory, and we'll get into mortgage rates, what percent, are those are moving. But again, February, a little outpacing the month, but just a good start on listings. And then again, here's percent of new listings sold. So this is Utah real estate only is the only source we have for this. But last year we ended at 63% of all listings that came on the market ended up selling. So just under 2/3 of listings sold, off from the peak of 90%. You had a 90% chance if you threw your home on the market, it would sell, but definitely still better than 2011, where 49% of homes were selling back then.
Yeah, I think this is an important conversation to have when you're listing homes, right? Because there's a lot of people that still think everything that goes on the market or 90% of what goes on the market is going to sell. And the reality is 63% of it's going to sell. So you've really got to be dialed in with your pricing and your marketing. The days of just throwing a property on the MLS and waiting for the showings to roll in are gone.
Yeah, I think one of the burden on our agents the last, year or longer has been, communicating relevant information to sellers because a lot of the
Absolutely.
sellers that are selling right now were also the ones that bought in 2020 and 2021. And it was just an entirely different time period of, how aggressive you had to be on offers, how little did sellers repair, things for you, like the likelihood of selling, all that stuff. It's just, it is a re-education, 'cause a lot of sellers aren't paying attention to the market as close as they could be. So,
Yeah.
um, again, here's just month by month. February was a great month of just selling quite a bit of listings that came on the market. But here's that inventory of homes for sale, slightly up, 5.8% better start than we did last year of inventory of homes for sale. You can kind of see where that was. January was a great pop of just, inventory increase, but then the last couple of months, a little bit more flatlined. But we expect usually inventory to go up just as more homes are coming on the market, just that next like 4, 5, 6 months, right?
Yeah.
Pending sales, this is your under contract. So this is things going in pending status. Again, like that snapshot, we're up 1.68%. Again, this is one of those categories. I think if we hadn't had this turmoil of, the Middle East and oil and that, I think our under contracts, our closings, I think we would see a lot bigger increase. So it's still positive. We're starting out better, but I just still think there's a little bit of that wave that could be coming once we get a little bit more stability in the market. Pending sales monthly, but then here's average days on market, up 12.6% in the United States, average days on market. And then let's even look at Utah. So again, even though inventory, we've seen more listings, inventory, kind of for the most part feels like last year, but one of the things that's changed is average days on market. So this does include under contract time period, but 76 days on market, including that under contract period.
Again, a really important conversation to be having with sellers. what time frames can they think about? When do they really want to move? We need to start talking to people sooner than we did in 21 or 22. And
Yeah.
even last year, you need to plan for a little bit longer time on market.
Yep. Totally agree. And usually you see that seasonality as well. Days on market starts to dip. Things start to speed up, sit on the market a little less. So hopefully you were fixing for a great hot summertime period for everybody. The showing index. So this is basically an index that tracks the quantity of showings on properties. Higher number basically dictates that the average home receives more buyer showings in a given month. So we've seen that go up so far this year. So that's usually a predictor of future, business. So again, 129 on that showing index, year over year percentage. You can kind of just see where we're at on that. But again, just the quantity of showings compared to the start, we're down a little bit from last year's first quarter. Mortgage rates, you hear the word mortgage rates. You could be at a restaurant and you could hear the word mortgage rate from across the restaurant and you just eagle-eared, whatever they said about it. But we're
Your
right
your
there.
spidey sense goes off.
Yeah, right. It's like when you're in real estate school and you hear the words real estate, you're like, huh? I'm a real
Huh?
estate. 30 years, we've been trending at 6% for 33 years. We are right there, right around that 6.11 average mortgage rate, 30-year fixed in the country. In perspective, again, still way better than the last 50 years, just with all those 80s mortgage rates. I can't imagine having a mortgage rate of 16% on our home. That would 10x your payment. Who knows what that would do? But again, 6% still isn't as awesome as our low rate time period, but I think we're kind of going to be around this rate for a while until we see a little bit more predictability in the economy. But here's the latest projections. I think last quarter, Gordon, correct me if I'm wrong, almost every projection forecast of mortgage rates when we did this in January was projecting lower rates on average throughout the year. And then here we are, two of the major sources. You look at the Wells Fargo forecast, you look at the MBA, the Mortgage Bankers Association, which they know what they're doing too. They're projecting 6.2 rates is what we're going to be kind of averaging throughout the whole year. Bless Fannie Mae. They close a lot of loans. They're still giving us some hope that we'll see some fives on average throughout the year, but they're projecting 5.7 kind of over the next 12 months. What's your thoughts on rates, Russie?
Man, I just think we're going to see. I think we've seen this is they bounce up, they bounce down, very little movement. I think this is going to be. I actually, if I was betting gal, I'd probably go with the Wells Fargo forecast. I think we're just going to stay really steady where we're at. I think Fannie Mae's being optimistic. There is some uncertainty that could tend to try to push some rates lower to drive interest, but I just think I think we're the name of the game for me in 2026. I feel like everything's pretty stable. I don't think we're going to see drastic drops or huge increases. I could be wrong,
Yeah.
but that's kind of that's my feeling I'm getting.
Yeah, the market's not going to tremendously change our agents'
Yeah.
income. It's going to be the work ethic and productivity that's going to
Right.
change our agents' income. Go get your unfair share. But again, I think just the Iran thing, the oil, just a lot of craziness is mortgage companies and trying to future pace a 30-year mortgage, if not even 9 years on the average mortgage. They want to know what's going to kind of happen a little bit more confidently.
Yeah.
And so even just the Federal Reserve, they had a vote, this week. They chose to keep rates at the same on that Fed rate. It was something unique was there was four of the Fed chairs that were they call them dissenters. They dissented, which is a higher number than it has been for a long time. Typically, that can project that there may be a rate cut coming the next time, maybe in June or whatever the next date is, Gordon. But even again, the Fed rate doesn't necessarily change mortgage rates if there's a lot of instability, but there could be another positive sign if we see another Fed rate cut. Here's your monthly mortgage rates. Still, 7.62, didn't love that. So I still love the low sixes, but even if we do hover around kind of that 6.2, 6.0, that's not terrible. But again, the fives, here's your 15-year that you can still go get a 5.58 as of last week. 6.23 is your 30-year. Here's your weekly chart. In oil, we've seen the oil prices go up. We know it. We immediately feel it at the gas pump. Somehow, The second something happens with oil, the gas stations in 17 seconds also change their prices. And I'm like, did you really buy oil for what it is today? I don't know how that works, but we felt it at the pump. The problem with oil, Rusty, is it ripples into every
Every single
avenue of our dang economy, right? Like delivery drivers, plastics, rubber, like it's just like airlines. You're hearing airlines potentially running out of jet fuel, like so no doubt oil prices going up is always a big headliner because that could contribute to inflation in
yeah.
so many different ways. But this chart specifically kind of overlays the oil prices and the mortgage rates. You saw late 2021 when oil kind of like really jumped up. Right after that, mortgage rates jumped up, right? And then you start seeing that down, and it doesn't always follow, but there are quite a lot of commonalities on here. So the fact that oil jumped, that little purple on the far right turning upwards, I don't love that. So treasury yields, again, the most, comparable number that kind of tracks is this 10-year treasury yield. If you're not paying attention, pay attention to this one. 10-year treasury is one of those things I look at usually every morning just in my little stock tracker. But 4.2 was the most latest up-to-date 10-year treasury yield, which right there, 6.29% mortgage rate. And usually that spread, can mean a couple different things on just risk and instability of the market. But here's your 30-year fixed rate mortgage overlaid from the Fed funds rate. So that's what I was talking about. So, a lot of times they generally move in the same direction-ish, but sometimes the gap between the Fed funds rate and the mortgage rate isn't always the same. So you look at what was that end of 24, the Fed funds rate was 5.13 and mortgage rates got to 6.18. There was a 1% difference in that. But then you look at now, which is crazy, just barely in March, 6.1% mortgage rate, 3.64. We're almost 3 percentage points different on that. And usually that gap has to do with just, the risk, the instability, economic challenges, basically mortgage companies just feeling like they're not going to make as much money on a skinnier margin.
Yeah, I think these bigger gaps are just there's risk there, and the mortgage companies see that.
Yeah, yeah.
And especially when mortgages are staying in place longer, right? You're seeing
Mhm.
that risk as even a longer term risk.
Yeah, yeah. So here's our national mortgages. Again, 68.6% of mortgages have rates of 5% or less. So as we see the mortgage rate kind of come down a lot, it's going to, as it comes down, it unlocks people staying in their home and frees up that inventory, and you start seeing that turnover pick up. So this has decreased. We were at like 75, even 80%
Yeah.
a while ago. So you're starting to see that turnover and be reflected in who has rates above 5%. So you even get into the fives on mortgage rates, you're going to start seeing more of this inventory, unlock. But still, a tremendous amount of our homeowners out there have low rate mortgages. Utah's even more extreme. Again, 80.1% of mortgages have rates of 5% or less. So what's that? 19.9% or above 5%. This still has gone down several percentage points the last time we talked about it. But just, yeah, majority of homeowners are locked into low mortgage rates still. So this is something Gordon and I, we talked about the other day when we were prepping for this, Rusty. But the Fed, they told us at one point or another they're going to start buying mortgage-backed securities. Usually, the two levers they have is the Fed funds rate, changing that, which banks can borrow money, that type of stuff. But then also it's the amount of assets they hold and what percent of those are mortgage-backed securities. They have been selling. They haven't started buying. They have been selling straight for the last 3, 4 years. They now hold under $2 trillion of mortgage-backed securities. When they buy those mortgage-backed securities and the Fed holds them, it frees up credit availability in the mortgage market typically out there. So like the more they hold, the more lending kind of happens. The more they tighten it up, sometimes it shrinks the credit availability. But if you look at Fed reserve assets in general, they have started buying some. They're just not mortgages. So I don't know what that is, but they're now officially holding 6.6 trillion. And then you see that Fed funds rate has dropped pretty significantly the last 2 years. And then here's the MBA, the Mortgage Bankers Association Purchase Index. This is what our mortgage people love to watch. Are there more purchases, more applications, more refinances come down the pipeline? But here is mortgage applications slightly up. So our mortgage people have seen a 12% increase starting out this year, 169 on that. Still not the heyday for mortgages, but still we're moving in the right direction for our mortgage industry. Here's weekly, kind of been hovering around that all last 12 months, kind of pop up, pop down, pop up, pop down. But then here's the mortgage credit availability index. So that has actually improved. So when you saw the mortgage-backed securities held going down still, it was surprising to see this number going up. And we don't know the exact answer, but me and Gordon were, palm, palm theorizing. What's the word? We basically think that potentially deregulation could be freeing up some mortgage credit availability as well. So
Yeah, because generally when the Fed is buying pretty much anything, that goes up. When they start restricting, it also restricts the mortgage credit. So this is surprising to me.
pontificating, Russie, is that my word?
Pontificating. I think that's it.
Theorizing. Here's just monthly mortgage credit availability index, just outpacing each month last year, which is great. And then here's our refinances, pretty decent pop, 112% increase at that 1320. I think that whole last like 6 months of rates going down, you start seeing a bunch more of those refinance applications coming through. So again, back in the heyday, it was one refinance for every purchase. A lot of those mortgage people are doing now. When it really dropped, it was 1 out of 10, refinances to purchases or something. So I think we're starting to see that refinance market come back. I know even a lot of our landlords and investors have just a ton of trapped equity that if they had lower rates, they'd refinance and pull some of that out. So I think it's starting to move in the right direction. Here is just on a weekly basis, the mortgage refinance index. And again, it was a lot of last year popped. So let's talk about foreclosures. Typically we say it's still nothing compared to the Great Recession, but this is the first time, Mike, we need to be paying attention to this. Look at some of these changes. So right in the middle, you see total filings. So this is quarter one 26 comparing to quarter one 25. Even though the quantity, the actual number is still significantly lower than back in the recessionary time period, the change percent increase concerns me, Russie. 26% increase starting out this year on total filings, 28% on starts, 26% on auctions, 32% on bank repossessions, and 28% of completed foreclosures. And one of the things, Rusty, that we were chatting about is I've heard so many scenarios of homeowners actually really far behind on payments that
Yeah.
the bank hasn't even started the process. Normally back in the day, you got 90 days, bam, the NOD was going out. I've heard of people being 6 months, 9 months behind payments, and the bank is somehow being really patient. Like I think taking back homes, they do not want that to happen. They hopefully want that homeowner to just figure it out and sell and catch up. So the fact that these numbers are as high with even that happening in the market could be even more concerning. So what you
That's
thought?
what I think. I think this is probably not completely accurate to the people that are actually in default or in trouble with their mortgage. I think this is important conversation to pay attention to and be watching, and even paying attention with your people and just being in good conversation with people, because the sad part about this is there's a lot of equity out there too. So are these completed foreclosures? Is there equity in the home? They don't know what to do, right? They don't know the right direction to take. So this, I
Yeah.
think, is one we've really got to watch. I haven't been overly concerned about foreclosures just because when you look at it historically, the numbers are so low. But like a big pop like that, up 26%, 28%, that's a big increase from Q1 for
Yeah.
Q1
Yeah. The speed
comparatively.
of increase is concerning. We got to watch that.
Yeah.
So here's our affordability again. Some of those other categories demonstrated this, but like affordability going up is positive. We want things to be more affordable, rates coming down, even prices kind of just flatlining or, kind of stabilizing a little bit has been beneficial to our homeowners. That affordability challenges has been in the news every day since, COVID basically, but 116 on the US affordability, just starting the year out strong on just some better numbers on that. We'll see how the summer goes. But same thing on Utah, a little bit better increase. We're at 80 on that index scale, primarily just because our purchase price is just higher than the median in the United States. But 80 on that index, starting the year out a little bit stronger on affordability as well. And then let's jump into investment properties. Anything else on those main categories, Rusty, before we kind of drive into these
No,
niches?
I don't think so. I think again, kind of my my feeling is prices are stabilizing. I think interest rates are pretty stable right now. I think there's people thinking about moving that hadn't been thinking about it, and paying attention to the affordability factor is a big deal. And also the foreclosures, I think we've got to keep an eye on those for sure.
Yep. Yep. I agree. Either way, it's a good start to the year. I'm excited for it.
Absolutely.
Hopefully, the summer and spring are awesome for our agents out there. But let's dive into investments. So, investment properties. I know a lot of you on the call own rentals or you represent a lot of investors, but still 80% of single family rentals are owned by those mom and pop investors, 1 to 9 owned category. You've seen even a couple of executive orders that Trump signed on banning institutional investors and stuff. A lot of those orders he signed still have to go all the way through Congress, to pass things. But at least there's some pressure on keeping, those institutional investors out of the single family game. But you look at, here's another great chart that Gordon put together, but here's kind of just rental rates at a glance. Statewide average rent is up 3.18%, which is great. We kind of saw 2 years in a row on average of rent kind of coming down a little bit. The highest rent is up in Summit County. The lowest rent out there in Duchesne, the Chesney County year over year gross summit, 9.3%. Right there. So you can kind of see, pick your county, what has rents done, but overall, somewhere around 3, 4, 5% increases for most counties. But then here's that reflection of kind of what we've been doing historically. We got into COVID time period, rents were kind of cruising up just like everything else. And then we had 2 years in a row, 24 and 25, went backwards on rent, even though mortgage rates are going up and the actual mortgage payments and ownership costs were skyrocketing. Our renters all around the state actually saw prices getting better. So definitely renters have benefited at the expense of whoever's paying that mortgage payment. You can see average rent per county right there. But even median days on market of rentals has slightly gone down 4 days. So things are turning over a little bit more, but even available rentals has gone up 16% more rental availability out there. And even though days on market's gone down with that much more inventory coming on. So. Okay, and even me, I had my property manager email me yesterday or 2 days ago for 5 of our rental properties, just on, hey, we're renewing this. It's a renewal time. This is the rent that we're going to ask. And out of 5 of them, I had 3 of them that they recommended, hey, we're just going to stay at the same rent. I had 2 of them that were like a $50 bump this 12-month renewal. So I think we're going to kind of just see probably a little bit of nominal growth, but it does seem like we're trending with some positive rent increases for the year of 26. Here's our fair market rent set by HUD, all the counties, whether it's studio to 4 bed. This is the federal housing assistant threshold set by the Department of HUD, depending on your county, what's out there for all those government assistant programs. But here's even Salt Lake City average rent. Same thing. This is just one of the great sources of just solid data that we get. But you've seen pretty much every category over the last 2 years. Same thing, kind of went backwards a little bit, but year to date, kind of starting out where we were last year in some of those categories. And then here's our Utah housing profile on just the rental housing market. Another great kind of snapshot with a lot of data on it. But we have 61,345 renter households that are extremely low income. So if you look even at that pie graph below, extremely low income renter households, what's going on in that household? So you see some single caregivers that put them in there. You see some in school with 3 O's. You see disabled, 19%. You see seniors, but then 43% of those low income renter households are in the labor force and still in that low income threshold. So with all those categories, the latest projection is we are missing 44,000 rental homes that are built or they're available for those low income households. So I know even a lot of just the talk is just how do we aggressively go find more rental households for low income. But the average income limit for 4-person extremely low income is that $32,000 number. You even see 79% of extremely low income rental households with severe cost burdens. So just a bunch of great data on that. Here is our average rent growth for 1 and 2 bedrooms in the country. Even 26 in the United States starting out lower, even though Utah's gone up a little bit. Here is the average rent growth just kind of on a month-to-month basis. Kind of flatlined, a little up and down with seasonality. But here's US new builds for rent, two or more units. So this is basically duplex and above. So kind of multifamily built for rent. Could be big apartments, could be duplexes, triplex, fourplexes. We dropped quite a bit last year. So 460,000 in 25 were built and put on the market. And then 580,000 in 24. So pretty big drop. 24 was a good inventory year. One of the things that shocked me, I had to fact check you, Gordon, from last year and even kind of where we're starting out, is the vacancy rate, how much that shot up in the state of Utah. I almost thought that was a mistake, but it has shot up. Last year, we passed that balanced 7% vacancy. So Utah last year, 7.6% vacancy, and even the United States, 7.1% vacancy.
I think with that, Johnny, I think a big piece of that, you saw that big jump up in 2024 with new units being created. There's a lot of large apartment complexes that weren't they in places you didn't see those. Typically, Weber and Davis County, you're seeing tons of just huge apartment complexes in Syracuse, in West Haven, just a lot of those things. So I think that makes sense that the vacancy rate is going to also increase, right? Because you're creating more in 2024. You're going to see some vacancies changes in 2025.
And also the turnover was a lot slower for a couple of years there as well. So that kept the vacancy rate lower than it probably should have been.
Yeah.
Yep. You're exactly right. When I look at all these categories, the story that it tells me is yes, affordable rentals, we're missing a lot. If you even
Yeah.
look at just the houses that we need, we are underbuilt. We need more homes built for the potential homeowners. The one category that we have done well and probably even a little oversupply was that multifamily apartment type of inventory, which when you blend all those out, it has overall increased our vacancy out there. We keep seeing this kind of going up a little bit. Annual average operating expense per unit by county. So this is just for your unit, the operating costs in there, not counting your mortgage payment. Davis County, you guys are expensive up there. I don't know what you're doing. Maybe you got a Costco nearby. Who knows? So let's talk about the economy. We're going to hit GDP, unemployment, real wages, inflation, a few definitions. Here is real GDP. So year over year, starting at quarter one, 2.7% real GDP growth. Lot of data center, a lot of AI investment. That is for sure driving a lot of our GDP. U.S. unemployment trickled up just a little bit, 4.3. That 35-year average is 5.7, but I know that's one of the concerns is we're starting to see unemployment go up, job openings going down a little bit. I think about some of the AI, replacing potential jobs. Even one of the categories, just the quantity of money that's being spent on just experimenting with AI is taking away from dollars that could be paid to, employees that they're having to budget around. You've seen some of the tech companies have some, layoffs, but here's job openings slightly down out there. The unemployment rate is that purple line, and then the millions of job openings. You've seen that kind of going down year to date just a little bit. And again, overlaying those two on a line graph, we like to see less unemployed, more job openings. We crossed, several months ago. So officially, more unemployed people than there are job openings. And then here, I think, Gordon, this is the first time we've seen all negatives. We've usually had some positives, but here is job openings by region inside the United States and then job quits. So you've seen really the Northeast has had the most dramatic job opening decrease, whereas, the South almost flatlined on job openings. But normally you see a lot of these being positive numbers the last several quarters that we've done this. So real unemployment rate, you got the U3, which is the one that we usually track. If you go by the U6, that includes underemployed, marginally attached, and discouraged workers. So somehow they're finding all those discouraged workers out there that are being added into that number. But here's even the annual labor force participation rate. You see Utah, again, we tend to lead the nation. 67% of our population are in labor force, 62 in the United States, but even 25 to 54-year-olds in the nation is 84%. You're starting to see that 55 and older, we've lost about 5% the last couple of years. But here's job growth. Every quarter, they announce jobs created. Every month, they announce jobs created. This is one of those categories that they'll announce something. It'll hit Wall Street Journal and all the news publications. And then the next quarter, when they announce it, they go back and revise the previous quarters. I think, Gordon, you said this is one of those categories when they went back and revised every quarter of 2025, it was actually lower jobs created than when they initially publicized it, right?
Yeah, by significant number.
So 2025 total jobs created 181,000 allegedly in the economy. They could even go revise this. I bet if they revise this, we could end up at like a neutral number potentially. So we'll see. Job growth, here's those categories. Here's one that Gordon created as well. Healthcare and social assistance has really been the industry category that has led some of the job growth. In the red, you saw where the job shrinkage has came in. Trade, transportation. I think government probably could be a potentially good category to see in the red, but 195,000 less jobs in government. Construction, was positive to see that. We've seen a rebound with 68,000 more jobs in construction. But it's just crazy. Those social assistant healthcare job growth, just tremendous out there.
Yeah, that's massive.
Real wages, this is when we track wage increases weighted for inflation. So we like to see this be a positive number, that inflation isn't wiping out, the increases in pay that our employees and people around the country are seeing. So 1%, 1%, 1% the last several years. Even though we had wage increases again in 2021, 2022, when you added inflation because it was so high, it wiped out and actually your dollar was going, less far. So here's the payroll wage index. You see that kind of going up, 207. So starting out the year, 4% increase on that. And then here's one, Rusty, just people moving around. You see headlines, but this is income. So you know that net worths are moving, especially in some of these states that are trying to tax the net worth of people. You're starting to see people leave California, New York out of that. This is based on IRS data of adjusted gross income. So this is like income taxable. Where is it moving? California has lost $12 billion of income. And then you also see New York lost 10 billion. Florida's been the winner. A lot of income streams are moving to Florida, 21 billion. You've seen 6 billion. A lot of that is state tax driven, whether it's a lower or even a no tax state tax rate on income. But you see Utah, 477 million. We still are seeing a tremendous amount of wealth and income moving in, which has been what's driven up our prices quite a bit. Illinois was another random one, 6 billion out of there. I guess Chicago maybe.
Mm. Yeah, it's
Um,
interesting when you look at how decreased the wealth flow out of California, minus 12 billion, and their population isn't really being super affected. Wealthy
yeah,
people are moving out of California. They're tired of those taxes.
wealthy people out, homeless people in, I guess,
Yeah,
right?
I guess. Yeah.
And negative 3 million Hawaii. Who's moving out of Hawaii? Those people,
Yeah, I
I
don't
would
know. Those
stay.
people
I
are
would stay.
crazy. They moved to Florida.
True, true. So inflation, we kind of stopped talking about that for a little bit as we were getting in check, but I think with some of the oil and the effects of oil going up, like the concerns are inflation, right? I think the Fed, Jerome, he even said that when they were talking, just the concerns about inflation in the future because of the ramifications of oil. But let's just hit a couple of these. Right there, that yellow line, we were right, kind of stabilized, but we've seen that pop, which that is the yellow is the CPI that includes energy and food. So no doubt fuel, oil, that type of thing has just swung that up. When you exclude energy and food from the core CPI, we're still seeing great stability in there. A lot of times it takes time to see, some of those go up if oil is affecting those categories. Here's just from the KW research, the vision speech, the projections were that we were going to end at 2%. That was the real goal, getting both those down. So I think if we see a quick change and a solution on the Iran thing, get Hormuz open, get all that stabilized, I think we could still potentially see this, but the longer that drags out, the way less likely we're going to see positive, things happening on inflation. Here's those categories that contribute to the inflation. we're doing our part here in the real estate. We've seen interest rates go down. We've seen real median home payment go down. We've seen real rent growth go down. Median home price just nominal, but no doubt energy, fuel, gas, natural gas, electricity, all those categories going up is what's pulling the inflation up. We were kind of a negative contributor to the last inflation run because housing was going up, that type of stuff. So we were kind of bringing that number up. We're now helping it for the most part. You were talking about this, Gordon, the PPI and the PCE categories, the producer price index. This is another usually future kind of predictor that what could happen to prices. So the fact that we popped up on the producer price index 4% at the end of March could be an indicator that we might see a little bit of inflation going up, right, Gordon?
Yeah, unfortunately, these two slides are the ones that the Fed really looks at carefully when they're considering rate cuts.
Yeah.
And this one jumped for the first time in 3 years.
Yeah. Which is your personal
Percentage-wise.
consumption expenditures, your PCE, which is, that going up is also we're spending a little bit more money either on more stuff or prices on those things are going up, which could impact inflation. Average revolving consumer debt, say what? We saw a slight decrease, $1, I guess, in billions, but that's a little good. Not sure what might have driven that. Do you know who's not doing that? Is the federal government. They are not bringing their revolving debt down. They're going up officially at the end of last year, $38 trillion, chump change to some, but to me, that's a big number.
Chump change to some, but not to Johnny.
Federal debt, is it the Rothschilds? That might be chump change. I don't know. Federal debt, total average public debt as a percent, being at above 120 is no good. Listen, anything Ray Dalio says, he talks about that 120% of debt based on your GDP. So that means we have more debt, 120% of our total GDP, which means more money is going to paying your debt. Just imagine if you had 200% more debt than you did, income, no doubt, that would be hard to service the debt. But here is our personal savings rate of disposable income, seasonally adjusted, slightly down, 4%. So 4% versus 4.6% last year. We like to be at the 6.1% number or above. This also was interesting. All commercial banks average deposits went up. So we're up 6.1%. So somehow those deposits at banks are going up, even though disposable income savings rates gone down a little bit. Manufactured durable goods slightly up again, just what they're manufacturing things for could be a predictor of price increases. Purchasing managers index starting out 5% above. But here's just the summary. A lot of times the direction is what we look at right here. New orders are growing, production's growing, employment's contracting, supplier deliveries is slightly slowing, inventory is contracting, customers' inventories too low, increasing prices, increasing backlog of orders, imports increasing, new exports decreasing. Overall economy, it still looks like it's growing. Manufacturing sector is growing. That could be part of the movement of just trying to bring a little bit more of our manufacturing back home. Who knows? And then advanced retail sales. So this is again the predictor of just retails making their purchases early, 3.7%, but flatlined from where we were last year. And then consumer sentiment, us optimistic Utah. Look at that purple line, pretty much flatlined where we were last year. We're at 80 on that index. Those pessimistic United States citizens outside of Utah, they're at 55 on that. So again, our lowest point was 59. 2022, and we popped back up. So I think for the most part, a lot of Utahns are feeling pretty okay with the market. Where more pessimism's coming in the United States. You can see just on that month to month, we peaked 1124.91 on the index, but still all the 22, 23, we've been outpacing that. So I think the stability and just like the slowing of the market, on rates, just not as volatile. Usually we view that pretty optimistically. So let's zip through Utah economy. Again, we still have one of the best economies out there. We'll go through a bunch of these categories, but just in general, Utah's economy moderated, early 2026. Job growth slowed down a little bit to 0.6. unemployment still is low. Key sectors, continue to expand. So we'll jump into some of these categories. Here is the economic impact of real estate. Gordon, this is a new fancy chart you got for us. This is basically $69.2 billion or 21.9% of our GDP was due to the real estate industry. Gordon, what do you feel about this chart?
It's higher than I thought it was going to be. This is a new NAR report that they put out earlier this month. And I was a little surprised that we were in the 20% range.
Yeah. Which, like, even California, like, we typically, you'd assume they have high prices, a lot of real estate out there, but it's actually a lower component of their GDP than Utah. Some of the highest ones you see is what, 25% of Florida, Arizona. So interesting. Thanks for this chart. But here's just a snapshot of Utah. We've gone down a little bit, tied fifth highest annual employment growth. Usually, I think we're in the top three, but even being in the top five, still tremendous employment growth. We still have a very high labor force participation at 67% of our civilians, citizens are participating in labor force. This has gone down. We're tied for the 19th lowest unemployment now. We're at 3.8%. Usually we have trending, single digits unemployment, rankings on the state. So I think we've gone backwards a little bit. We're still the youngest, median age at 32. We still are the best at making babies, average household size, the largest in the country at 2.92. Still the low poverty rate of 8.3%. But here's another category that stuck out to me. The number one state for adjusted income, cost of living, adjusted household income. So $98,000 household adjusted income, which
Yeah,
is
this is huge because I think for a long time, the household income in Utah wasn't really keeping up. So this is a big bump for us and definitely a step in the right direction connected to our pricing.
yeah, I agree. Totally agree. So here's population. The latest study, we've heard a million people are coming, but the latest study put out there by the Kempsey Gardner Policy Institute, by 2065, 30 years from now, Rusty, when you're turning 29 years old, we will have 2 million more people in the state of Utah that'll be all on I-15 from 9 a.m. and at 5 p.m., which is great. So 2 million more. You can see what counties percentage base will be growing the most. This one jumped up there, Wasatch. Wasatch will increase 186%, fastest growing, even though it'll be about 60,000, just percentage. That's a big one. But look at Utah County. They're all coming to get me, Rusty. 832,000 people coming the next 30 years in Utah County. Your favorite, Wayne County, we might be moving down there, only 1.5 thousand down there. Salt Lake County, again, will be adding 400,000, just hitting right at 1.6 million. Utah County and Salt Lake County, 30 years from now, will be almost pretty much the same size. So we'll see who is cooler then. Utah industry growth, kind of just that same thing, what industries in the state of Utah are growing. Utilities, real estate rental and leasing, we've seen a bunch more jobs in there, but you see information, you see trade and transportation, some other services, but even mining shrunk a little bit by 500 jobs out there. But here's our unemployment. Just like the country, we've trickled up a little bit. We're at 3.8%. Still great. Normally, if you're under 5, it's still phenomenal employment statistics, but just seeing that move in the wrong direction is usually a little uneasy, I guess. Here's it on a monthly basis. Really just starting the year at 3.8 is kind of where it popped. But real GDP percent change. So this is just overall state growth of their GDP. Utah is doing pretty dang good in comparison to a lot of states. We had 1% GDP growth. North Dakota, that's got to be oil driven right there, 3.8. You look at South Dakota, 3.0. Texas, Arizona, some positive numbers. We have a couple states shrinking, I guess. But here is all GDP in billions, $241 billion of GDP in the state of Utah, 25. Year over year growth, still growing our economy. But here's personal income growth. So the United States, last quarter, when we did this, last couple of quarters, the United States was actually outpacing Utah. We've caught back up, so we're kind of right neck and neck with the personal income growth. from Utah and the United States. And then let's kind of wrap up with some construction slides. Again, we've talked about some of them a little bit, but new single family home starts. So starting out a little behind last year, but we're annualizing somewhere around 957. We want to be right around that million number or above to start cutting into our inventory deficit. So overall, United States. But here is a little bit what we're talking about. So the purple is total building permits pulled. Orange will be your residential building permits pulled. You just saw a ton in 2020 and 2021 in Utah. And then 23, look at those drops. 2022 dropped 22%, 23 dropped 35%. So I think we're starting to see a little bit of that lack of inventory coming on. I think a lot of our builders are trying to put their foot on the gas pedal, but again, supply chain, labor costs, regulatory issues they have. But overall, the latest update, we're going to need 153,000 more homes than we have right now by 2030. So we have 4 years for our builders to get roaring to cut into that deficit of the lack of inventory. We still remain the one of the fastest growing nations, but that shortage, and these are the states where they have the biggest shortage. Utah County will be 46,000 homes short in the next 4 years, almost the same in Salt Lake County. But even Washington, look at Washington, our St. George crew, Cedar City, 22,000 homes short out there. Here's that supply gap. So cumulative shortage, pretty much from 2017 to 2022, we were doing well. We were actually eating into that. We started seeing a light at the end of the tunnel that we could end up getting to where we needed to be. And then boom, we start going backwards. So every year we're adding to that cumulative shortage. The forecast is we'll be officially 44-ish, 45,000 short, by the end of this year. Our goal, the state has a lot of goals out there, but one of their goals is by 2028, they've created 35,000 new starter homes, which is great. I know that's a big category of affordability issues. You just see the home deficit by 2055 could be 235,000 homes. 80% of metro homes have been deemed unaffordable. So you're starting to see people having to go even farther to go get affordability. But any comments on this?
I just think with this, we've got to really watch. We talk about needing more homes, needing new construction starts, needing things to really just start pushing forward. And this is where a lot of the land use, the legislation, all of those things we've just got to really pay attention to. We've got to make it easier for builders to actually build affordable housing.
Absolutely.
And especially affordable housing, single family homes.
Yep. AI will save us. AI will save us, Rusty.
It's going to save us. We don't know how it's going to save us in that area, but it's going to save us.
Robots
Yep.
do it. Residential housing starts in billions, starting out the year in Utah a little bit better. So housing starts, so a little bit more homes starting the first quarter this year than last quarter. So moving in the right direction. Price indexes of new single family homes under construction. So kind of predicting, some increase or appreciation in those. New multifamily residential under construction. You're seeing the same thing in the United States. But builder confidence pretty much flatlined. We're below that 23-year average. This is nationwide. So overall, nationwide, builders still aren't the most optimistic they've ever been, but they're also not the worst it's ever been. Here is monthly, a little bit up and down on seasonality, but still kind of been the same numbers on average the last 2 years. And then the last kind of category we talk about is debt. So what's going on with debt in the world? Here's total debt balance and its composition in the United States. We're $18 trillion in debt, Russie, as a country. These are the citizens. Here's mortgage originations by credit score. A lot of green out there for your 760 and above credit score. Auto loan originations. I'm wanting the auto market to slow down a little bit. I got to buy Matt on a car here in the next 2 months. If we just see these go down a little bit, then I can get a little bit better deal. But total debt balance by delinquency status, again, kind of that foreclosure conversation. We don't want to see this going up, but it has been with a little bit more red of severely derogatory late on delinquency status. And these are the categories. Student loans was a lot of just legislation issues. We start seeing a little bit of those delinquencies going down. Credit cards, that's concerning. You're seeing a
Yeah.
lot of that just kind of skyrocket. Mortgage HELOC, pretty stable, but slight increases in auto. And then transition into serious delinquency, still that student loan category. Do we have to pay them? Do we not have to pay them? Kind of issues they were having. And then again, new number of consumers with new foreclosure and bankruptcies going up, going down a little bit the last couple of quarters. But then third-party collections, proportion of consumers with collection. And that is it. So, final thoughts, sending our awesome agents with your last couple pieces of commentary or advice. What say you, Russie?
I say that pay attention to, I think you need to be having these conversations with your clients. So to me, it's have really good conversations with your sellers and your buyers. Let them know what to expect. Pay attention to the foreclosure rates. That to me is one that, again, I haven't been overly concerned about it because it's not a huge number, but it's a big increase. And so I think pay attention to that. Personally, my name of the game is I'm just going to go back to I think we're just going to continue to stay stable. I feel like we've seen some stability. I think maybe we'll see a little pop in prices again, kind of depending on what's going on with everything else in our economy. There's a little bit of uncertainty, but for the most part, I appreciate in Utah that we're pretty stabilized. I think it's about having the right conversations and being a consultant for your people.
Yeah. Gordon, any final comments from you?
No, I agree with Russie. Everything is going to remain stable pending inflation. If nothing drastic happens, the middle part of this year, I'm not seeing a lot that's going to be changing.
Yeah.
Well, specifically here in Utah.
Yeah.
Yeah.
I think here in Utah, it's going to feel a lot like 25 did.
Yeah.
So if you loved 25, that's great news for you. Keep up the great work. If you
Yeah.
felt like there was a little to be desired, I think you've got to look and shift some strategies. I think you can't expect a lot I think you can't expect a lot different to happen in 26 than what happened in 25,
Yeah,
personally.
I think we're just in general in a good, stable,
Yeah.
healthy real estate market for buyers
Yeah.
and sellers. I think the positive is we're starting the year out a little bit stronger. I think even like how much stronger we would be if we didn't have the turmoil going on. So I think if there's still some things ahead of us that can be solved, can only be a benefit and more of a green light for our industry. I think the market we're in is the market we've known for, a year, 2 years, which is positive. And I think you've got to pay attention to everything, read the news, do these market reports, and then ignore it and just go to work that day, and just go out earn and out produce and just, outwork, our people out there that don't want to work as hard. I definitely think this is still could be the best year that you ever have. Just you got to go earn it. So signing off again, these slides are on kwutah.com and then kwutah.tv if you want to watch the recording tomorrow. But thank you for being on. Use these reports, share it with your buyers and sellers. Thank you, KW family, and all of our guests. Thanks for being on. Have a fantastic last day of April.
Bye, guys.
See you, everybody.